Hello. As more people want the world to be powered by electricity, it's inevitable that more copper will be needed to turn that dream into a reality. Let's see how that relatively new change in supply and demand affects Mark's investment portfolio in this, episode 8 of The Desert Island Investor. Okay, Mark, you've recently added to your holding in Central Asia Metals, ticker symbol CAML, and this is a stock you've held for a while. So tell us more about CAML.
Hi, Paul. Well, just starting from the top with some of the basic numbers. It's got a market capitalisation of 355 million. It's got a PE of 5.2 and a yield of 10.3%. I haven't got the yield and the PE the wrong way around. That's 5.2 PE and a yield of 10.3%.
Now, this was first listed in 2010. When did you invest?
Yeah, I invested back in August 2014 with the price at £1.73. And then I've added to it at various points over the years. Again at £1.73, £1.62, £1.77, £1.88, £2.22. £2.17, and then just a couple of weeks ago at £1.89.
So investors obviously look for capital growth and compare the current share price with the share price journey. But even though there are fluctuations, dividends are an important consideration too. And I believe that's the case with CAML.
Yeah, it's been don't forget about the dividends, Paul. And I think this is something that we can use as a prime example. Because I was looking at if you were to look at the share price as it is today, and it's £1.95, and if you were to use that initial price that I bought into, 9 years ago at £1.73, you'd be thinking, well, you don't seem to have made a lot of progress there. But since that time, the dividends that I've received over those 9 years total £1.31. So, putting that into context, or if you were looking, and the thing about dividends is that we receive them, and sometimes we forget about them. So if this had been a business, for argument's sake, that had retained all its earnings into the business, and that was reflected in the share price today, the £1.95, adding the £1.31, you'd be looking at £3.26. So you'd be thinking, oh, that doesn't look as bad as what I first thought. So. And another way that you can look at it is that, the £1.31 as against the initial £1.73, that's an 8.4% yield. Or you can say that it's, I've had 75.7% of the original investment back. So I'm already, I'm getting back to being in it for nothing, in a sense. Obviously, we've had inflation over that period of time, but I'm just using that initial investment price for this argument. If you look at the subsequent investments I made, they're all at varying degrees of payment. Some might be at 40%, 50% of that initial price. So one of the beauties about once you bought a share is that you get the returns in perpetuity.
Now, as the podcast title indicates, the unavoidable consequence of striving to achieve net zero is that the demand for copper is increasing in order to build renewable energy projects, electric heating systems, electric cars, and in expanding the EV charging infrastructure. So I'm sure that most investors would agree that's a pretty reliable growth forecast. So investing in associated raw materials seems like a no-brainer. However, I know that you generally don't like mining stocks, so what are the reasons you're wary about them, and what makes CAML different?
Yeah, this is one of these paradoxes, Paul. Yeah, so there's various reasons that I don't like mining companies, and I'll go through most of them. It's not going to be totally exhaustive, this, but very often you find that they're in politically unstable and corrupt countries. The very nature of it is the asset can't be moved in the event of a seizure or an act of God. If we got a widget factory somewhere and we encounter problems, we can move that factory somewhere else. Or if it's Unilever knocking out pot noodles, it's quite easy to move your production. You can't do that when the asset's under the ground. Now, because of that, you can't move the asset, strike action is more likely. The workforce know that they've got you to a certain degree over a barrel. It's very often a dangerous working environment, a lot of heavy machinery and people working underground. There's a lot of dangers there. Often capital intense. You can burn through a lot of cash in order to get to the resource without anything coming in. So there might be a bountiful resource under the ground, but you run out of cash before you get to it. And then you've no control over the selling price. It's it's a commodity product. You're producing whatever it is, lead, copper, zinc, iron, and you can't enhance the value in any way. So you're a marketing man, Paul. There won't be much of an opportunity for you, I don't think, in a mining company to say our copper is better than anybody else's. And then there's the threats to the environment. You can have spills and leakage into rivers, scarring of the land. And, if you remember, probably over a decade ago, it's a different kind of mining, I suppose, but it's on the same principle of the Gulf of Mexico oil spill, but BP. That has caused huge problems. And recently, Rio Tinto have blown up some caves in Australia that were 46,000 years old. That hasn't gone down too well. So, and those are just a couple of ones in recent history, and there's a lot. I think back in the day, people could just do what they want. They've got to leave what they leave behind is very, very important now, and they've got to leave it generally in a better state in which they inherited it. And then again, as I've said before previously about mining stocks, the asset is being depleted and finite. Each year, each day, there's less and less of it. And also, you're trying to predicting what is there is sometimes difficult. It might be more, it might be less. So you can't always be exact about what there is to go at and what the life of mine might be. So thus, I probably put you off investing in mines totally there, Paul.
Oh, absolutely. Yes. I think the exploding thing was probably where I lost interest, but it didn't stop you. So CAML, different situation?
Yeah, well, there we have it, Paul. This is the paradox. Given all those things, given that argument, then why do I find myself going against that? Well, so I think this business, Central Asia Metals, is a little bit different, and I'll give some reasons why. It doesn't tick all these boxes, but it just alleviates a few of my concerns. So this is a company that IPO'd in 2010, and at the time it had the Kunrad facility, which is in Kazakhstan, and it's when we talk about miners. So this is a former copper mine, conventional mine, which was operated through an open pit mine process from 1936 to 2005. And it's been left with a lot of, waste dumps in which there's a lot of tailings. So this is actually a solvent extraction, an electrowinning copper facility. So I don't see this really as a conventional miner. The copper's on the surface. All the copper's in the surface. So that's a major problem taken out from me. And what this solvent is doing is basically leaching out the copper out of those dumps over time. So I don't see this as a mining company, more as a kind of metal processing business. So that was where I saw an exception there. Now it was originally a joint venture, 60-40%, in that, 60% was attributable to Central Asia Metals. And then in May 2014, CAML bought the remaining 40% off the holder. So that made it a little bit tidier. That was before I got in. And, they've been leaching away at the eastern dumps. They've moved then across to the western dumps. And this life of mine, they're going to call it a mine, is out to 2034. Now, I've also mentioned the Heritage Index. So we're talking about, political instability in countries. And Kazakhstan does rank relatively well. It's positioned at 71, which is classified as moderately free. Nevertheless, they did have a little bit of a problem in early January 2022 when they had some civil disobedience and some protests, and at the bequest of the Kazakh government, Russia sent some paratroopers over to try and help the situation out. So that seemed to get sorted very quickly. And as you know, Russia are involved in Ukraine at the moment. Now, Kazakhstan was the last Soviet state to leave back in 1991. So there's always a risk that, what are Mr. Putin's ambitions? But at the moment, it seems, very stable. And I would suggest that he's got his hands full looking elsewhere. So, that was all part of, Russia was also a part of something called the CSTO, which is the Collective Security Treaty Organization, which groups together Russia, Kazakhstan, Belarus, Tajikistan, Kyrgyzstan, and Armenia, Paul. So I thought that was a little bit of an exception. That's where I think that ticks a few in my concerns, is that, this is a very low cost operation because the copper is basically there. You can look what it is. You're not having to dig it out anymore. Now, at the same time, they also had a concern in what's called Copper Bay out in Chile. And Chile is another attractive country to deal with. On the Heritage Index, it scores at 22. And as I've said, mentioned it before, but this is like shorthand for how business-friendly countries are. And this was a copper facility operated between 1938 and 1975. And it was it seems similar to the Kazakhstan operation, in that the copper tailings were on the beach. So, we're sat out looking at our beach, Paul. Can you imagine that? A beach full of copper. It must be like El Dorado, or El Cobre, I think it will be in Spanish. So that was looking very promising. Central Asian Metals made a $3.2 million investment back in 2013 when they had 50% of the equity. Then they increased that to 75% in 2015 with an extra $3 million. But then when it came to the feasibility study in 2017, it was, they found out that they wouldn't have the resources to make it profitable. So that's basically not going forward now. They still own that asset, and I think it's up for sale, but probably who else wants it now, saying that Central Asia Metals have already said it's not feasible for production. So there was that, and then after that they expanded. So I would have been happy probably for them just to carry on, run down the asset that they've got in Kazakhstan. But in 2017 they bought another mine, a more conventional mine at Sasa in North Macedonia, and that's a zinc and lead mine, so that's more conventional. And this is where we mentioned Central Asia Metals, probably a little bit of a misnomer, because this second facility is in Europe, so it's a major concern that they've got. So don't just think that Central Asia Metals are in Asia. So Sasa, it was mined between 1966 and 2002. Then when it had faced bankruptcy, production resumed in 2006, and then Central Asia Metals purchased it in 2017. It's another low-cost facility. North Macedonia scores at 56, again, moderately free on the Heritage Index. And at the time of the at the time of the purchase, it was $402.5 million, and that was financed by a mixture of debt and placing of extra shares. So if we look back at December, at the end of the year 2017, net debt was $138.9 million. And as of the 31st of December 22, all that debt's been repaid, and the company now has a net cash position of $60.6 million. So, they've paid that debt off now, and it's looking set fair, I would say. Just as a little bit of an example of the split, Paul, on I think what shows an example of what a great facility it is in Kazakhstan, is that if you look at the revenues, and this is just on the last year, so it will depend on the total tonnage that comes out and the price of the commodities. So it's copper at Kazakhstan, in Macedonia at Sasa, it's lead and zinc, but 53.3% of the revenue was coming from Kazakhstan, with just 31% of the number of employees. So 2/3 of the employees are in Macedonia. Just a third at Kazakhstan, and Kazakhstan is 53% of the revenue. So it just goes to show what an advantage is that you don't have to send people under the ground. And when you look at what Kazakhstan are doing, what they're doing at Kazakhstan, it's a waste material. It's a good story for ESG because they're reclaiming all this copper out of what we say is just a dump. So I think that's a good merit to have. One of my concerns is this turning into something else, a slightly different beast? I was happy with the Kazakhstan operation. It's then morphed into, it's gone to another jurisdiction. It's gone to other metals in a bit more conventional mining. Okay, it's spread its risk a little bit, which is an attraction. But one of my concerns is that we look at the two. So I've asked the question on the cash position. What's going to now you've paid off this debt? What's going to happen with all this cash that's piling up? In that, are you going to do share buybacks, or are you going to do a special dividend? And on both those cases, the management seem to be quite opposed to both of those. They don't like paying specials, and in general, they don't like share buybacks because they want to expand the shareholder base and not contract it. So that's leaving. What do we do with it? And just my concern is that in the kind of, if you've written those other two things off, they're looking at another acquisition that my concern is that they could get this wrong. So I hope they don't, and they've been very astute up to now. But as these two lifetime mines are approaching 2034 and 2039, could they just buckle a little bit and say, well, we've got to do something with this money, so let's just buy this asset. And people who are selling to them know that that they need to be buying something else and expanding. So I think that will be the case whereby if they bought something that was a bit more of see if it was more of a prospecting kind of concern where it wasn't productive already, then that's something that could concern me.
But other than that, you'd say a good investment.
Yeah, it's done. Dividends are a major part of it. It's a good company in that they've got a dividend policy, and that is to return between 30 and 50% of the free cash flow. And the last dividend they paid was 20 pence, which is equivalent to 47%. So if you look at the cash that they've got, so that's 60.6 million. When we gave those PE figures earlier on, and the yield, you've got to, and the market capitalization, you've got to understand that quite a percentage of that is actually cash that's in that valuation. So you've got to factor that in. But that cash valuation was at the end of December. You would I would expect that it's higher than that at this point. We know they're 6 months on now. Again, as we spoke about in a former a previous podcast, when we're looking at these numbers, they're all historic. But it's been a very cash generative share. And when you're looking at a portfolio, I don't think there's just one stock that's going to tick every box. You're all looking for them to do slightly different jobs, like you do in that football team, and they're all contributing to the cake. So I'm very, very pleased of what's the role that has been, and as you point out, Paul, the need for more and more copper as we go down the electric route. It's I don't think that's going to go away.
CAML. I've been trying to avoid calling it CAML because I thought I might get told off, but I'm going to call it CAML now. So, do they have a website?
Yes, they do, Paul. Lots of information on there, Paul. It's centralasiametals.com, and it gives the share price and the daily copper, zinc, and lead prices. If you want to follow that.
Right. Well, thanks very much indeed, Mark. For those new listeners, we have a spot called Question in a Bottle where you can quiz Mark about an investment-related topic, and that is coming up next. But first, you and the raft went missing again last week, and we've just received a parking fine from the Thames River Police. So what's been going on?
Yes, Paul. We mentioned MP Evans back in episode 4, and my main reason for going down to London for a few days was to attend the annual general meeting, my first one there, and the 150th celebratory dinner, lunch, should I say, at the Mansion House. But prior to that, it was a great opportunity to meet up with some contacts that are relative to some of our previous contributions. John Walter, who was the non-executive at Zytronic, which we covered in episode 2. He's a very, very knowledgeable investor. Also, David Barry, who I met at both the Zytronic and Titan AGMs, and he's recently increased his holding in Titan from 3 to 5%, so that was interesting. And good to meet up with our friend over at in the company of Mavericks, Jeremy McEwen, where we covered him on episode 6, and also Ben McEwen, who's an investment director at Dowgate Capital. So, yeah, busy few days. Yeah, so back onto the actual annual general meeting, and it really was an excellent networking exercise, Paul. Mate of mine that was down there, Ken Baker, but I met some other shareholders up to in the past. A guy called Robert Stevenson. We hold some similar stocks, and then there are many familiar faces there. I think Christopher Mills from Harwood Capital was there, but and also at the champagne reception, it was Elaine and I formed a nice little quintet with Andy Bruff of Schroders and Tamsin Freeman of PR World and Rebecca Stewart. So, it was really good, chatting to them. But, the real value, let's not get away from it, is the discussions with MP Evans and getting to speak to the directors. And when I was in the reception, I had my name badge on, and the chairman, Peter Hadsley Chaplin, came up and looked at my name badge, and he said, I've been waiting to meet you, Mark. So I was very flattered that he actually knew who I was. He'd listened to the podcast. He had nice things to say about it, Paul, and us. And he said that he thought we'd done a good analysis of it. And he said that as a result of that, he sat me next to Charles Hall of Peel Hunt. So I was actually flattered. Not only had he listened to the podcast, but that he knew actually where I was sitting, and it was good to again to have conversations with the CEO Matthew Coulson and the CFO Luke Shaw. Again, they gave me plenty of time. Like I said, there's over 100 people there, so they're very generous, and that was this event lasted from I think about 10 a.m. until about 3, something like that. So you could really get around, really get to speak to the employees. I think all the employees from the UK were there, because there's only 7. There's only 7 employees from the UK at MP. There's 11,500 at Indonesia. So I don't think that'll look good on a pie chart. But it was, they had employees over from some senior members over from Indonesia. It was good to meet them. And they had one gentleman there who'd started with MP Evans back in 1943, age 14. So that was a really nice touch having him there. And I was, I'd made my initial investment in MP Evans, and I was further encouraged by this now. I've looked in greater depth, and if nothing changes over the next couple of months, I can foresee myself adding to my position there. And I've got to say, as far as engagement, this was an absolute PR masterclass, Paul, of how to engage with your shareholders, because let's not forget about it, they're the people who own the business.
Okay, right. Well, that's all cleared up. Thank you. So let's get on and see what the question in the bottle is today. Right, this is a question from Amit Vedhara. If I pronounced that correctly, yeah?
Yeah, Amit Vedhara. He is a non-executive at ShareSoc.
Oh, okay. And Amit asks, in future podcasts, can you mention the Share Your Voice campaign and ask your listeners to sign the petition for fixing shareholder democracy?
Yeah, well, this has been, I think, headed up by Archie Norman from Marks and Spencer, and we'll certainly mention it, which is what we're doing. I won't ask other people to sign it, because it's all, like we said with the investments, it's do your own research, Paul. We can tell people about things and share what we think, but it's ultimately up to individuals to make their own mind up whether they think it's something that's worth backing. So I think there's a good. It's a good idea in many ways, but a little bit of potentially a curate's egg in that there's potentially something that could go amiss, and we'll get onto that in a minute. But basically, you got to respect what they're trying to do. And it's a 5-point plan, and I won't go through the 5 points. I'll just try a bit of a shorthand. But really, it's trying to fight the corner a little bit, modernise the interaction between retail investors and the companies in which they're invested, because increasingly we go through brokers and like myself, and we're our holdings are with nominee accounts. So we're not the legal owner. We don't have title of the shares, but we are the beneficial owner. So so it's difficult sometimes for private shareholders to have direct access, and private shareholders, private investors, they can get a bit of a bum deal. There's investor briefings sometimes that only analysts are invited to. Private investors can't go. You have to get permission sometimes to attend AGMs. Sometimes there's placings whereby companies are looking to raise capital, and that just goes out to institutions, and your private investor is frozen out of that, and their holding is diluted. So, every credit that, they're trying to raise the profile for the private investor. The one concern I've got is when it comes to annual general meetings, and they are wanting these to be held, or the possibility for them to be held virtually, in that it's not, you don't have to go to a physical meeting, because I can understand it can be expensive, or it can be difficult to get there, or what's to stop a company holding its annual general meeting in the Outer Hebrides on the 24th of December or something like that at 9:00. But I do think that there is some credit to having some merits, still having the physical presence at an annual general meeting. And I know that the engagement appeal, which is headed up by Cheryl Cusa and Danny Wallace, they're fighting this corner that the annual general meeting should be a hybrid affair, and that's something that I back. So I think they've nearly got it right on the they've got 95% of it right on the Share Your Voice. My concern is on the stance of the annual general meeting, because I don't know how it will be held if I submit a question, Paul, and is somebody going to read that out for me? Are they going to put the same tone on the question that I would have? Are they going to slightly change the question? they might decide not to ask the question. And also, depending on the answer that you get, are you going to be allowed a follow-up? So I just think that, and I've been to various AGMs, most of them are good, but occasionally you just know that they want to get that over as quickly as possible. And that, the directors have probably been, heaving up in the toilets before the AGM because they don't like them. But, this is the one chance that we've got a year, a legal requirement, we own, as I said, we own that business. So these people, all these directors, they've been advising people what to do throughout the year. This is our chance to question them. And it's not always aggressive questions, but it should be that they are held to account and, stand before you. And I just think there's something a bit like that you get out of a physical presence, just like I did with those meetings that I've had, down in London. We can do things on Zoom and by email, but I think there's just still something there about the human interaction that's worth so much more. So like I say, that's have a look at Share Your Voice. It's up to you to decide what you think, to get that petition to go ahead of the into the House of Commons. For me, I think they've got it 95% right, but you decide.
Is there a website? I mean, or if you just Google Share Your Voice, I'm assuming that will turn up with the...
Yeah, if you look either on ShareSoc's website, or if you just put in Share Your Voice, I'm sure it'll come up.
Well, that's all for this episode. We hope that you enjoyed it. Please remember the content is for information only and it is not financial advice. If you would like to pop a question into a bottle for Mark, just post your question in the comments and hopefully it'll reach the island in time for the next episode. Thanks again for listening. See you next time.